or if you need to drop off a little bit early or anything like that, we will also send out the recordings and the slides after the webinar. We do aim to get them out at the end of the same day or the next day. So you will receive a copy of the presentation as well for your own benefit. And again, if you have any questions on the back of those, then you can obviously reach out to us on Nwabisa directly.
Sure. So I think I'll make a start now. Thank you, Jess. So today we'll be talking about the current market or the current mortgage space, and in terms of sort of the current market turbulences that we have been experiencing. As Jess said, my name is Nwabisa. I've been with Ascot Wealth Management for about 5 to 6 years now, and as a mortgage advisor, about 3 to 4 years. So just some quick disclaimers. This presentation is for information purposes only and doesn't constitute any financial, legal, or accounting advice. Please do seek financial advice before making any investments decisions. And of course, please do ask any questions or feel free to reach out to me on any of the information that is presented. So just some business expertise. So we do deal in the first-time buyer market, new residential mortgages, buy-to-lets, limited company mortgages. So do feel free to reach out if you have anything that we can help you in this space. So today's webinar structure, we'll be talking about the current market turbulences, some challenges to remortgages and new mortgages, some lender interventions, and just a basic overview of the current house prices. In terms of the interest rate space, we'll be talking about UK inflation, inflation contributors, interest rates, and the big question of have we reached the peak, and we'll talk a little bit about the rate forecast. In terms of inflation, it's probably been the biggest subject in terms of the media and sort of everybody's talking point, how prices have increased. This is an overall sort of seeing that in sort of money or purchasing power. Inflation is excuse me. Sorry about that, everybody. I had some technical difficulties. So as we were saying, as I was saying, to start on inflation or to sort of the sort of current interest rate market, we'll be looking at the UK inflation, which is sort of seen in the increase in prices of overall purchasing power. As we've seen in the market in the last week, in that sort of July, August numbers, those have decreased from about 6.8% over a 12-month period to about 6.7%, which is generally good news in the overall market. And we've seen that in sort of how the rate market has reacted to that. So the inflation is basically measured through CPI, which is the change over time in prices of goods and services. I'm sure everybody has felt it when they're going to the supermarket these days, that sort of the things that you used to be able to buy for a certain price have exponentially increased. So the sort of consumer price index is tracked through the Office of National Statistics, which tracks the price of sort of a basket of goods over time. And then we have core inflation, which excludes price of energy, food, alcohol, and tobacco. So some of the key contributors to inflations, Again, the price of food, which I'm sure everybody has felt, products like alcohol and tobacco, clothing and footwear. All these goods and the cost of these goods have contributed to the current levels of inflation. So taking this back to interest rates, basically, the Bank of England is using or the monetary policy of the Bank of England is using interest rates or interest rate increases to slow down inflation. This influences lending and savings rates that people are getting. One of the key influences is that as the interest rates increase, which as we've seen over the last sort of year or sort of 18-month period, the Bank of England has made exponential increases to the Bank of England base rate, up to a point where we've now reached a base rate of 5.25%. Last week, this was sort of also set to hold by the Bank of England. And this was due to the positive numbers that we've seen below or previously of the 6.7 inflation increase, which over time was obviously meaning that the interest rate increases that the Bank of England has been making is starting to work. So in terms of interest rates and how mortgage lending is then affected, banks are able to borrow borrow money over the long term, and they use what we call swap rates in order to do that, which usually fluctuate and are affected by the inflation in the market. So this means that the real interest that they are receiving is constantly changing due to swap rates or the cost of them borrowing. So that's why over the last 6 months or over a year, we've seen a lot of lenders now, due to fluctuating swap rates, take rates off the market, reprice their rates, and also obviously the high rates that we've been getting in the market. But the Bank of England is trying to use this monetary policy of increasing interest rates in order to drive down inflation. And what that does is, because people have to spend more on borrowing, and also basically they then have less money to spend on other goods, which then drives down the inflation in the market, or sort of the supply in the market for those goods. So that's the relationship that we've been experiencing over the last 2 years since the Bank of England has exponentially increased rates. As I said, there have been about 14 rate hikes in this period. So the quick question is, have we reached the peak? As I said, last week, the Bank of England decided to hold rates at the 2.25%. Most of the market was expecting that to continue to increase at 5.5%, which then brings people to sort of, one, we were exceptionally happy. You'll see also in the news, there were headlines everywhere about the Bank of England having kept the rates at 5.25% and what that means. We might, at this year, we do have another sort of 6 weekly meeting coming up towards the end of the year, which another decision, or that which the monetary policy will then have to make another decision as to whether to raise the rates further or to keep them at 5.25. But the overall market sentiment is that we can now, or that the interest rates that have been put in place are starting to work. This normally takes about an 18-month to 2-year lag just to sort of start to feel those interest rate hikes take effect throughout the market. So the reason that we think that we may be at a point where the Bank of England is ready to sort of halt increasing these rates is because they sort of need to play the balance of also not of one, curbing inflation, but also not constricting the economy as a whole, and also maintain financial stability. This normally then is also compounded by such things as employment, wage inflation, economic growth in the overall market, and then other global economic factors. I would mention all of the things that were involved or sort of contribute to CPI, the Consumer Price Index. So we basically want to see, or the Bank of England basically wants to see that the interest rates that they are putting into place is having an effect on inflation without crippling the overall market. And so that's why we have been seeing this balance that they've been implementing. So a little bit on trajectory, or where we think we're going. As I said, we foresee that most likely they will stay at a 5.25% to 5.5 towards the end of 2023. We think that, or sort of from what the Bank of England is saying, it will take a little bit longer for the bank's base rate to decrease. We'll see that in 2024, they're projecting sort of getting down to 4.5%, depending obviously on the overall macroeconomic factors, which contribute to how much or sort of how much inflation we're going to see, and inversely what the bank, or how the bank decides to respond to that. We see that it's only really forecasting that to come down to 3.25 by the end of 2025, which basically means that the rates that we're currently seeing in the open market now most likely will be here to stay, especially over the end of 2023, 2024 period. We've seen a number of lenders respond quite quickly towards sort of how the rest of the market in terms of inflation decreasing. The Bank of England also keeping the rates as they were over the last week, or actually over the last month to last week, and even this week actually. We've seen a lot of lenders decrease their rates, which is good news, especially for those people that have sort of been employing the wait and see how interest rates will increase. But as you can see from these projections, that we most likely will be staying at this current market for some time. So what does this mean for the person who's obviously trying to remortgage, people coming off their current fixed rates, for buy-to-let, and also for new mortgages, i.e. first-time buyers entering the market? So we see that some of the challenges in the market currently, obviously due to high interest rates, many people will be coming off the deals that they currently had, which were probably, or which were around 1 to 2%, depending on sort of when they got into the market on the 5 or the 2-year fixed rate. About 2.4 million of these deals are projected to be coming to an end in 2024, which basically means a large number of people will need to be refinancing. And the cost of refinancing, you'll find that now is about double or almost 3 times what it was when the people previously got that mortgage. And so people are at a point where they need to sort of spend less on certain things in order to be able to afford their mortgage. But we'll talk a little bit more about what's currently available in the market and some of the things that somebody can do when they're looking to remortgage, or if you're coming off a fixed deal. Some of the key questions that I get from clients is whether to sort of take a short-term rate, a 2-year fixed rate, or a longer-term rate. Obviously, there are discount rates and tracker rates, and what the benefits of those are to the individual, which most of the time the answer can be quite dependent on the person's circumstances and their disposable income and how much sort of they are able to pay. But as I'll sort of come on to, there are different ways that we can make sure that everybody still remains being able to afford their mortgage. Another key question that I've received quite a lot in this period is, should you pay off your mortgage? Many people sort of have savings and investments in the background, obviously, and now you're sort of finding that what you used to pay and what you're going to have to pay is quite substantially a lot. And so many people are saying, or sort of say that at that rate, I definitely sort of want to decrease my mortgage so that I can pay less, and also to sort of benefit from a lower loan to value, which is the LTV, or sort of debt ratio. So those are the things that most residential remortgages are looking at right now and what they're concerned about. So I put a scenario in place just to sort of explain, or so you can see as well just how much this affects people. So joint mortgage that was taken out in 2021 with a rate at that time of 1.07% on a 2-year fix. This was a part and part mortgage, which means there was capital and interest paid. Property value at the time was about 1.34 million, and the debt they were looking at was about 854,000. So at the time, we had employed a strategy of 50% interest only and a 15% capital repayment on that mortgage. So in 2021, that individual's monthly repayments were about £1,502. Well, in 2023, having to remortgage, that goes up to about £3,900, almost £4,300, which for a normal household is a lot for them to sort of absorb. At this point, the individual's options, one could be to pay down a chunk of the mortgage. That would bring down their interest, or that would bring down their monthly repayments. Some people are also looking at repaying some of their interest-only mortgages, and also prolonging the term or increasing the term would help this individual to sort of be able to pay less, especially if that capital or that interest-only and capital repayment strategy is reversed or inversed. On the other strategy, on the other scenario, another mortgage, which was on a 5-year fix taken in 2018, that person was paying about 1.99 on a 5-year fixed. At the time, that was a repayment mortgage at 71% LTV, so about a 490,000 debt. So that, as a repayment mortgage, that's come down to about 428,000. But the 2018 monthly repayments were about £2,108. In 2023, even with the significant decrease in repayments, that will sort of on a normal remortgage be about £2,900 to £3,000. So we can, in these scenarios, see the significance of sort of where the rates were and the rates or the monthly repayments that people were used to, and how they're going to sort of have to restructure how they're paying their mortgage in order to be able to afford their mortgage. On the next slide, so I've put the lowest purchase rates and the lowest remortgage rates. These are off yesterday. This morning as well, when I came back, I could see that there were a number of lenders sort of announcing further rate decreases. So these are really good. So if you were sort of in my previous webinar in March, that webinar, probably those were probably about 5%, and we were even between June and July looking at looking at 6% 2-year averages. So they have come down, and the lenders have been able to respond quite quickly to the sort of or to the positive news that we've been seeing. Currently, the 10-year fixed rates are really good at about 4.3%. But again, we'll take note of the 6% early repayment charges. So if we do see if an individual does decide to go on a really long-term mortgage, and then at a later point decide to change that they're sort of locked in, or at least the lenders are then taking a 6% early repayment charge on that. The 5-year fixed rates have come down quite a bit, and so have the 2-year fixed rates. Those have finally sort of hit below 5% for the 5-year fixed rate. And actually for the 2-year fixed rate, it's been a while since we've been able to show rates at below 6%. So we can see that, again, there have been some improvements, a lot of them taking place over the last month. And that was sort of directly contributing to the inflation numbers that were seen as positive. And then also the Bank of England holding rates last week, which brought a lot of sort of market confidence and allowing the lenders to decrease rates. In terms of new mortgages, so obviously a number of people have sort of been saving for a deposit or trying to get onto the property ladder. First-time buyers are still accounting for about 53% of home loans agreed currently. That was all as of August this year. Interest rates are high. The key thing people are looking at is affordability. And I always say to my clients that are sort of, I have plans to purchase a property. This is how much I may have, or this is sort of more or less what I'll have in terms of a deposit. What is the affordability? And the good thing to be able to help clients in those regards is then to be able to sort of plan ahead. So it's a good thing if you sort of start early, and when, especially with how the market has been going, just to be able to sort of see what your projected monthly payments will be. Are those affordable? Which are the lenders that would be able to give you income boosters, so you can reach your goal of becoming a homeowner. We see that deposits have also really taken a slump, especially when people are trying to save to get onto the property ladder, and they sort of feel like that their money that they've been saving just keeps getting sort of eaten down into or dipped into in order to keep up with the cost of living. In terms of buy-to-let mortgages, over the last 6 months, what I've really seen in the market is the interest rate coverage ratio has increased. What this basically means is the lender's calculation on how much sort of maximum borrowing that a buy-to-let property would be able to afford, especially those lenders that look at rental income only in terms of maximum affordability. So I've found that where a property sort of 3 years ago, 2 years ago, when they were mortgaging and they were able to get a much higher borrowing from that lender, now going to a different lender and kind of having to remortgage and looking at the affordability, that's been eaten away a little bit. We've seen sort of for basic taxpayers that go between 125% to 130% on the interest or the ICR, the interest coverage ratio. And then for sort of higher taxpayer that also go from 145% to 265%. So it basically means that the property needs to be earning or needs to be getting more rental income in order to afford the maximum affordability. This affects people a lot that have interest-only buy-to-let mortgages, which I would say probably are most of my clients on an interest-only buy-to-let mortgage. So those are some of the challenges that we meet. I've seen that some of the lenders have sort of kept those lower RCI coverage ratios, but then there would either be higher interest or higher product fees applied, which I will come to a little bit later. And then there's sort of been also a number of clients that I've spoken to that sort of kept rent low for their tenants due to sort of having a relationship and understanding that everybody is under the is under pressure in terms of costs. Sorry about that. Sorry. Is under pressure in terms of costs, but then it turns out that when they actually it's time to remortgage, based on the current rates that are available in the market, their sort of maximum lending becomes less and less. Coming on to the current rates that are available for buy-to-let mortgages. I've put the product fees in place for the first time, just because we've seen quite an increase in what the product fee or the product fees that the lenders are charging in the market. So you might find that the advertised rate might be 4.19%, as you can see on my slide, but the product fees is then 7% of the outstanding debt, which makes the borrowing quite expensive over the fixed term period. And yeah, so that's something that I've seen that people should look out for. Whereas actually, if you were to take a little bit of a higher rate, which they have put as 5.51%, and you only get a product fee of about 2%. There are still some lenders that are offering product fees at the 995 that we're sort of used to, but generally those, as it will be quite high, probably about a high 5% to 6%, more 6% than 5%. So in sort of working with the clients or my clients that need to remortgage their buy-to-let properties, I'm constantly sort of having to play this balance of a low mortgage with a product fee that is reasonable and that the client doesn't end up sort of having to pay more in the long run. So what are some of the things that we've seen in the market just to help clients along? We've seen that lenders are allowing individuals to now switch from 6 months. What this is helpful for is obviously for the people to be able to plan ahead and sort of save if that they need to save. And then also, because the market has been quite turbulent, the rates that were available 6 months ago and the rates that are available now have completely changed. So this allows individuals to then get onto a good rate. You're also able to make changes to that rate. So if I were to get you a rate and then sort of 3 months later, we see that there is actually a better rate, even if you have sort of signed a rate switch contract with that provider, they are able to change that rate to the lower rate. So they've been very flexible on that. Overpayments have also increased from 10% to 20% with some lenders. Again, this is not everybody in the market employing this strategy, but this is helpful because if anybody wanted to sort of make a lump sum payment and get onto a lower loan to value, again, that can be helpful in terms of repayments in the long term. We've seen some lenders come up with a sort of helping hand, especially for first-time buyers, and allow them to sort of have a 20% affordability boost. Again, not all lenders are offering this, but that's why it's helpful to sort of be able to get in touch with your mortgage advisor early to be able to plan and then see as well which lenders can allow you to reach your goal of getting onto the property market. The income boosters, I spoke about these in my last webinar, which have sort of come into place for some of the lenders as well, which look at a 5.5 times income. That is subject to sort of the criteria in terms of your base income or your basic income. So that's tapered to the certain income. So they'll say that if you earn 75,000 per annum, then you would be able to qualify for these income boosts. But those are sort of strategies that people can then use to be able to, one, or sell their home or move to a new property because they can afford a little bit more. We're still seeing 95% mortgages. I have put there as starting at about 5.64%. And yeah, so I've spoken before about the joint borrower sole proprietor mortgages that allows a parent or a relative to also be part or to be party to the mortgage. So if you have questions about those schemes or those lender incentives that they've put in place, one that was quite interesting that is available with Skepton is a rental track record mortgage, which basically is allowing people that have been able to afford renting for a period of 12 months to sort of 18 months to be able to use the rental track record to show that they can afford a mortgage, because most of the time, as you'll know, with the price or with the cost of renting now, it's almost equal to basically paying off a mortgage. As well, the longer mortgage terms. Many more of my clients that I'm talking to, especially younger clients that are trying to get onto the property ladder, being able to sort of put your term up from normally the 25 years that most people would be going on, to extend that to 35 to 40 years has been really, really helpful in terms of affordability. And the lender also puts that into their affordability calculator, in that when you decrease the term, sometimes you can get a negative or unfavorable result, but on increasing the term, the mortgage becomes affordable, because on a repayment mortgage, then that means that your monthly repayments are decreased. And then the big thing about whether one should be on a repayment plan, or at least, one not being able to afford their mortgage, lenders are more likely to put an individual on a repayment plan or a payment holiday instead of repossess their properties. So they have been quite flexible, I've seen in the market, to try and help people along in terms of the current rate market that we are seeing. And then finally, in terms of the UK house prices update, sort of due to high inflation as expected, many people have sort of taken a step back or used the wait and see strategy in terms of whether to go ahead and purchase. So there has been a decreased demand over the last couple of months. That's currently 4.6% over the last 12 months as of August 2023. We've seen that the new average UK house price is recorded at 279,000, which is down £14,000 compared to a year ago, and has sort of reached early 2022 levels. But what this means, again, is that the pressures of high interest rates are sort of taking effect in the market, and more people are taking a step back as to whether they should be getting on the property market or property ladder, or maybe somebody that was planning to move to a bigger property has decided to not do that. So we're seeing that start to take effect in the market. The overall sort of market sentiment is that it shouldn't last, and especially with the interest rate decreases that have taken place over the last month, more people will sort of try to capture the market or try to sort of capture the current interest rates that are available and take advantage of the fact that, one, interest rates are decreasing, and then also the house prices has decreased. So that should be able to drive the house prices up again, and we probably will see that start to improve as we go into next year. So this is just a graph showing sort of over the average, the average decreases that we've seen. As we've spoken about, that it was a really big high in that August 2022, and that's taken a dip over time, again affected by overall market or macroeconomic factors. And hopefully we'll be able to see those become better as inflation decreases and interest rates decreases, and there's a lot more economic stability overall in the market. Apologies once again for that technical issue. That brings us to the end of our presentation today. If anybody does have any questions about any of the information that was presented, or would like to sort of run a scenario past me, please do book a meeting with me or a call with me. We can sort of discuss your specific circumstance and how we can be able to help you.
Lovely. Thank you, Nwabisa. Really appreciate your time there. There will be a small survey put up at the end of the presentation as well. So like I said, anyone who's got a couple of moments just to leave your feedback on there, that would be really helpful. And we will see you next time.